So I just thought that I recorded a video about this article, and it turns out I was actually streaming instead. Ooh, that was... I hit the wrong button. That was not cool, but I've since deleted it. So yeah, it did have some views. It's funny. This video is highlighting something that I've been talking about for a while, but haven't really had definitive proof for. It's just one of those things that was based on an assumption that the apes were making that seemed incorrect based on an amount of research I had done before. There was a case for this, but this article actually brings in some empirical evidence that kind of proves what we've been saying, and that is talking about the idea that the AMC influencers have been pushing for a while now, and it's kind of a central theme in a lot of the videos that have been coming out lately, and that is the idea of delta hedging. Delta hedging, the idea that market makers are buying shares based on call options that are being sold to the apes. The more call options that are sold, the more shares the market maker is buying. And as this article shows, that's probably incorrect. I'm just going to highlight a few things from this article because I've already read through it 3 times thinking I was recording it. So, of course, the link to this article is in the description for the video, as is the link to my Telegram finance chat, which you're all invited to join. If you want to get in touch with me, that's a better way to do it rather than comments. I don't tend to look at the comments as often as people probably think I do, but I'm on the Telegram thing all the time. So if you want to get in touch with me, that's a better place to do it. This article starts out talking about Robinhood and how the IPO kind of sucked. And then after options were introduced, the shares jumped in price, and that most retail investors think that it's because of delta hedging. However, it's probably not. And again, you can read all of this if you like, but I'm going to kind of just hit the highlights here. So we know that what options are. They're contracts that give you the right but not the obligation to buy or sell an underlying stock at a given price, which we call a strike price, by a certain date, which we call the expiration date. And if that's a contract to buy shares at a particular price, we call it a call option. And contracts that give you the right but not the obligation to sell shares at a given price are called put options. Okay, so conventional wisdom is that the mere availability of these derivatives linked to Robinhood stock gave the shares a boost thanks to market makers, or the companies that post bids and offers for stocks and derivatives. They're the intermediaries that most investors trade with. The thinking is that market makers and call options for Robinhood stock, which is a bet that the equity will increase in price, will also buy the company's stock as a hedge, driving up the share price. This type of trade, known as delta hedging, neutralizes the risk of price fluctuations for the market maker. So let's think about that for a second. So if the market maker sells a call option, they're selling it to somebody who's bullish on the stock. They think the price will increase by a certain time and by a certain amount. That forces the market maker kind of into a bearish position. If the price rises on the underlying stock, the market maker loses premium. They lose money, and the person who bought the long call position will make money. The premium will increase. So in order to offset that possibility, if the stock price goes up, the market maker's losing money. But if they buy shares as well, if they buy underlying shares of, in this case, Robinhood, and the price of the option premium increases, the market maker is going to recoup that amount that they have to pay out to the call holder. They're going to recoup that, or some of it, through the fact that they bought shares of Robinhood, which also increased in value, so they can use that profit from those shares to offset the loss from the call options, which rose in premium. Okay, hopefully that makes sense. And it's the opposite on put options. So it's exactly the opposite. If they sell a put, whoever buys that put is a bear on the stock. Therefore, that kind of forces the market maker into a bullish position by default. So if the stock price does go down, the put option is going to gain premium. It's going to go up, whereas the market maker is going to lose money because that premium is flowing over to the retail investor who bought the put. So what the market maker would do, on traditional wisdom, delta hedging, is they would short the stock and therefore recoup some of the money that they would lose if the price of the stock did go down and they had to pay that premium to the individual investor who bought the put option. They would recoup some of that through the profit from a short sale in the stock, which declined. Okay, so the article goes on. That's not what happens in these days in highly erratic meme stocks, according to 2 options experts interviewed by Quartz. So I said we're going to get some empirical evidence. We're going to get to it. When it comes to meme stocks powered by online sentiment from platforms like Reddit or Twitter and exemplified by GameStop and AMC Entertainment, market makers using this form of hedging can get burned, options experts said. That's because these stocks have broken down the typical relationship between options and the underlying stock. Part of an option's price is calculated based on its implied volatility, or a trader's guess as to the likelihood that a stock's value will change. When a stock price goes up, its implied volatility typically goes down. This makes a rough sort of sense. If a stock is going up, in theory, it's because investors have more certainty about its future cash flows and profits. And let's look at an example of that. So with Apple here, we see this downtrend in the middle of January, and we see the implied volatility rising. And then when we have the sort of relief rally here, recovery a little bit of the Apple stock, we see the implied volatility decline. And likewise here, we see an increase in implied volatility on this downtrend, and on this uptrend in the middle of March, we see the implied volatility decrease. Okay, so again, the stock price is rising, implied volatility goes down. Let's look at AMC. What do we see here? Well, we can look at this recent sort of pump and dump here. The pump side of it, we saw the implied volatility increase. And on the dump side of it, we saw implied volatility decrease. And here back in December, we see a rise in implied volatility with this price uptrend. And we see kind of a slow decrease in implied volatility over this period from mid-December through the end of January. Now, it's important to note here that we didn't see too much of a change in implied volatility over that period, right? There wasn't too much of a change. And it kind of makes sense because there weren't that many large moves in the stock. So we can see that reflected in the IV, and that's going to come back here in a minute once we get a little bit further in this article. But the point here is just that comparing this to Apple, in Apple, we see the typical kind of implied volatility movement, what you could think of as the typical movement in the VIX, implied volatility index for the S&P 500. When the VIX rises, typically we see a decline in the S&P 500 price, and when we see the VIX declining, we would see a rise in the S&P 500 price. So that's this inverse relationship here. Whereas on AMC and BlackBerry and GameStop, we see implied volatility rising on price uptrends and implied volatility declining on price downtrends, okay, which is kind of atypical. So meme stocks flip this around. The equity may shoot up in price, but it's reasonable to expect that this price increase is highly unstable. During a trading battle between retail investors and hedge funds, shares of GameStop skyrocketed in January to more than $300 from about $30 a few weeks earlier. It was reasonable to expect that the record stock price might come crashing down, or it would shoot up even higher. There was little to no way to guess what the price would do. The implied volatility arguably got more unstable as the price went up. So this kind of makes sense though, right? GameStop skyrocketed up to $300. It was reasonable to expect that that high price is going to decline by maybe the same amount that it went up, because it's kind of an unstable move. It's not comfortable up there. It shot up there really quickly. Is something that shoots up really quickly in the market, does that tend to stay there? Or does it tend to kind of revert to a more reasonable kind of level? Well, it tends to revert. If something works its way up and consolidates and pulls back, then pushes a little higher, and then pulls back and consolidates and then pushes a little higher, that's a more stable increase of price. But of course, that's not what we saw. We saw it shoot up. So is it reasonable to expect that that would come crashing down? Yeah, I think it is. So as one of the option experts they spoke with explained, this places the market makers in a dangerous position. Imagine a market maker sold a put on Tesla shares. So they sold a put option to somebody who has a bearish outlook on Tesla shares, the bet that the stock will decline in price. And the market makers likewise placed a short sale, a bet on the shares to decline, on the actual Tesla shares to offset or hedge that position. Again, so they'll recoup some of the money they have to pay to that put holder that they sold it to with their short position, which will also increase in value as the stock goes down. If the shares jump in price, though, the market maker will lose money on the stock short sale, right? We know if a stock is being shorted and the stock shoots up, the short sale becomes unprofitable, right? Normally, the option price might be expected to compensate for that. If you're holding a put and this price shoots up, normally the value or the premium of that put option is going to go down. You're going to lose money on the put. The market maker is going to make money on the put. But if the meme phenomenon is taking place, the put may, for example, stay at a steady price. because the implied volatility input in the option price, the neutralizing hedge is broken down and the trader can lose money. For call options, the situation is reversed. So just pop over here to AMC and we can see the same thing. Actually, a better example to look at is going to be Tesla. Here we go with this theory here. So if somebody bought a put over here somewhere and they thought the price was going to go down back in December, right? And actually this price shot up to 1200 again, okay? This is an example, exact example of what the article mentioned. So the short sale that the market maker supposedly is taking on as a hedge is going to lose money. It's going to lose money as the price goes up. This price went up by $300. It's going to be a very unprofitable position for the market maker to hold. What happened with the implied volatility on this uptrend here? Well, actually, the IV rose. It rose from about 60 to about 70. Okay, so the put option is probably going to decrease in value from the delta portion of the option, right? Simply because the option is going further out of the money if it's a put option as the price of the underlying stock increases. But via the volatility component's actually going to gain premium. So I don't want to say that the option would become more profitable, certainly not going to become more profitable, but it's not going to lose as much value as it would if the meme stock phenomenon sort of weren't happening here. But it is happening here, so the market maker would lose money not only on the short position, but also on the put option, or they wouldn't make as much money on the put option, we could say, right? So we see that right here. We see the price increasing and we see the volatility increasing, okay? So for call options, the situation is reversed, and we can look at AMC for that. Here, with this IV increase on this last pump and dump, on the pump side of it, if the market maker's selling a call option, they're going to buy shares, right? Well, they're going to lose more money on the call options if the price shoots up and the volatility shoots up by 100%. That's a substantial increase in volatility. That's going to drive the market maker's long position, which they bought to hedge, supposedly to hedge the call options, right? They're already losing money on the long position that they took on. Now they're losing more money on the fact that implied volatility increased by 100 points here on this uptrend. So it's really interesting, and it makes a lot of sense. Okay, so that's the reverse situation from the Tesla situation. To put things more simply, when it comes to meme stocks, the shares can't be counted on to offset the gains or losses of an option. This type of breakdown has happened in several stocks, including AMC, BlackBerry, Tesla, and GameStop. Market makers know this and have adjusted accordingly. And this is what we've been saying for a while. We thought that based on all of the evidence, based on some research that we've read, based on the fact that the apes and the ape influencers are hyping this as being the way it is, with no exceptions, we have speculated that it was probably not the case. So here we go with some actual evidence. Meme stocks are completely idiosyncratic. There is no natural hedge, said Steve Sosnick, chief strategist at Interactive Brokers. What's the hedge for AMC when it's going insane? The large market makers are much more likely to hedge these positions with other options rather than with the underlying stock. Quote, the best hedge for a call you sell is buying another call, said Sosnick, who was previously a trader at Morgan Stanley, Lehman Brothers, and Salomon Brothers. If you buy another call, you're hedging the volatility risk as well. Okay, let's think about this. The best hedge for a call you sell is another call. You're hedging the volatility risk as well. There's no volatility risk in shares. But if you're selling a call and you're buying another call to hedge with, and the IV changes, it's going to change on the call you sold, and it's going to change on the call you bought. So that's going to move in concert. It's going to offset itself, and it's going to be a much better hedge as opposed to buying shares. Makes so much sense. Meanwhile, a particularly large market maker may be able to hedge much of its portfolio with natural order flow, meaning it doesn't have to buy or sell so much for hedging. Another options expert told Quartz. Executives at Virtu Financial, a mega market maker, said essentially the same thing in an August 4th earning call when explaining the trading company's push into options. As a large market maker in U.S. equities, CEO Doug Sifu said, we have the delta hedge in all these products. Robinhood was rallying on a flawed theory. Though the conventional wisdom that market makers will buy up shares as a hedge for the options they're dealing in isn't accurate, it's still probably driving the market. Which is to say, If enough traders are willing to pay higher prices for a stock like Robinhood because of its options activity, then the hedging theory will work because people in the market seem to believe it's happening, even if that thinking is based on a flawed understanding of what's taking place. And this is sort of one of the things that we can observe with technical analysis as well, right? The actual technical analysis may or may not be accurate, but because enough people are looking at technical analysis, they're looking at the same technical analysis principles and same price levels and Fibonacci levels and all that kind of stuff. Because a lot of people are looking at the same things on the analytical side and trading based off of it. It's kind of a self-fulfilling prophecy. And that's kind of what they're getting at here with this, I believe. So this is a really interesting article. Again, the link's down there if you want to read the whole thing. But basically, the TLDR here is that according to gentlemen from Interactive Brokers and Virtu Financial, they're saying that the delta hedging theory of hedging options and options book by the option market maker is incorrect. It's outdated. It's inaccurate. It does not apply to the meme stocks because the volatility component is so far out of whack. It doesn't respond in the same old inverse way that typically makes sense, that would make sense to delta hedge that way. It makes a lot more sense to hedge right in the option chain. That way you're hedging the volatility risk as well, and you're not leaving yourself exposed to these wild volatility changes or lack of change in volatility, which is going to preserve some of the premium of the options that you sold, where normally you would be counting on that volatility change to eat away at the volatility premium and to make your side of the trade more profitable and the option buyer's side of the trade less profitable. So just another example, with evidence of course, of the AMC influencer grifters pushing an outdated, incorrect, misleading narrative, convincing people to buy into a stock based on incorrect information without doing their true due diligence. This article is from August of last year, so this has been out for a while. It's kind of embarrassing that we didn't find it until now, but we found it and we were highlighting it and we're bringing it up because this is something that has come back again and again and again with these influencers, these YouTubers, people on Reddit. A large part of this now is based on the fact that they believe that the market makers are hedging the option chain a certain way. And I've been saying for a while that, hey, that's probably not the way they're doing it. I didn't come at it from this angle. I came at it from a slightly different angle. But nonetheless, we questioned it. And ultimately, we stumbled upon some evidence that seems to substantiate our doubts about the validity of this theory. It's another example of how you have to do your own research. You have to be skeptical. You have to be a contrarian. You have to look for any reason why the information that you're being presented with might be wrong and try to find evidence, actual evidence, not a post on Reddit, not a tweet, not another YouTube video, but hard data, quotes from primary sources like executives at trading firms and brokerage firms and market makers. That's what you need, and that's what we have here. So I hope you found this video interesting and informative in some way. If you have a comment or question, leave it below, or better yet, join the finance chat. You'll be more likely probably to get a response from me there. I won't leave you hanging there. There's a likelihood I might leave you hanging in the comments here. I'm not great about getting to them and responding. It's not anything personal. I just don't have the time a lot of the times to go through the comments, and there's a lot of BS down there too. So I know if you're coming in Telegram, you're probably serious, and you're not gonna call me a cluck or whatever. Hey, maybe you will call me a cluck. That's okay. That's okay. I can take it because I know that at the end of the day, we're doing our due diligence. We're trying to find actual hard data that is useful, that actually provides some value, and hopefully fills in the gaps in this knowledge, addresses the assumptions that have been just blindly accepted by people. And whenever you have a situation where people are believing everything that you tell them, it's not good. It's not good, especially in the stock market, okay? We've been over this before too. But again, that's why you need to question everything, demand evidence. Where are the receipts? You need to see the receipts. It's tax time. You need your receipts. Otherwise, you might find yourself in hot water. Again, thanks for checking out the video. Subscribe to the channel if you're not already. Leave me a comment. Come in my chat. Check out other videos and enjoy the rest of your weekend. Catch you in the next one.